Hello everyone, welcome to the CMA live online class. Let's get started with our topics today. We are starting section B, topic 5, right? So we have seen all the important topics in section B, and probably this is the most important topic from the exam point of view. Overall, section B is 20% of the examination weight. It's mainly computational topic. Beside the first topic, that is strategic planning, we have already seen the importance of this topic. This strategic planning is very important for the essay type exam question, and you can always expect a question from strategic planning. Let's say you have to perform a Porter's 5-force analysis, or you have to perform a pestle analysis, political, economical, social, legal, technological analysis, given a scenario. But after this topic, you will see that the other topics in section B are less theoretical. And today we are going to start the most highly tested and most important topic, that is topic 5, that is the annual profit plan and the reporting schedules. So we have been talking about budgeting so far, and you will see that this is the topic or this is the chapter in which we will be actually preparing budgets. We'll be preparing sales budget, production budget, raw material usage and purchase budgets, labor budgets, overhead budgets, cost of goods sold budgets, and then overall budgeted income statement, balance sheet, and most importantly, the cash budget, right? So let's get started on our coverage. So here is our topic 5, annual profit plan and supporting schedule. We will discuss two types of budgets here: operating budgets and financial budgets. Let's get started with what is included or what is dubbed as operating budgets. Here, if you see, we have a big picture, and it always helps to have a big picture, that how everything is connected, right? So this big picture, if you see, this is a picture, overall picture of a master budget, and it starts with the sales budget, if you see, and this is the order in which we will cover these budgets: sales budget, and then from sales budget we will make a production budget, and once a production budget is finalized, we will be able to make direct materials budget, direct labor budget, and factory overheads or production overheads budget. Once these three budgets are finalized, from this, as you can see, we can derive a cost of goods sold budget. And once, as you are aware, we covered the once sales budget is there, cost of goods sold budget is there, we can calculate budgeted gross profit. Now, moving on, if you see, this is selling expense budget, admin expense budget. So you can see that at this stage we can make selling, general, and admin expenses budgets. And once we have that, and after incorporating the interest finance cost budget, and then after accounting for taxation, our end result would be a budgeted income statement or budgeted profit and loss statements, right? And as going forward, we will see this would be the end of operating budgets, right? So operating budget starts, number one, starts with the sales budget, and it finishes with the budgeted income statement. Once budgeted income statement is prepared, then we move on to the second set of budgets, which are known as financial budgets, right? So financial budgets, when we say financial budgets, the budgeted income statement is an input to these financial budgets, right? So if you see what is included in the financial budgets, we have cash budget, right? And we have budgeted balance sheet and budgeted cash flow statement. So these are the financial budgets. And now, if we look at this big picture, capital budget is a line item in cash budget, right? So when the time comes, we will talk about the cash budget. So capital budget is a line item in cash budget, and cash budget, or the ending balance cash, as see is an input in budgeted balance sheet preparation. And at the end, if we see the last budget here is the budgeted statement of cash flows. So what is difference between a cash budget and budgeted statement of cash flows? Frankly speaking, there is little difference. It's just a formatting difference. Cash budget is budgeted inflows less budgeted outflows over a period of time, but the cash flow statement, as you know, is same thing, but the various cash flows are classified into whether these are operating inflows or investing inflows or outflows or financing inflows or outflows. So this is the big picture regarding the master budget, which has two components, operating and financial. Now we move on into the details of each and every specifically operating budgets, right? So guys, I have told you this is highly important for exam, and there are calculations that we are going to see. We have to see that how these concepts are tested in exam. So if you see, this heading here is operating budgets, right? So now operating budget, as we saw, it starts with the sales forecast and sales budget. So I would put this as number one. So in order we have to make, so sales budget, we will see in an exam question, we typically are given the sales budget, right? That is an input in an examination question. Shortly, I'll tell you a typical format of exam question. So this is usually an input in the examination question. Number two, we will be making a production or inventory budget. Then once the production budget is there, as I've told you that in any order we can make then the direct material usage budget, direct material budget, direct labor budget, and the overhead budget. And number 7 would be the cost of goods sold budget. So material, labor, and overhead, you can make it in any order, but we have to start with sales budget, then with the production budget, and then with material, labor, and overhead budget. And once we have budget, then only we can make a cost of goods sold budget, right? And then in time, as we have discussed, selling, admin, general expenses, and then we will have a pro forma or a budgeted income statement. So let's get started with our first budget. So now, what are the inputs to forecasting sales, right? And this is a very, very important examination question, a theoretical question, that which one is the most critical of all the budgets, all the operating budgets, right? If I put this question to you, what do you think is the most critical budget, most important budget, right? In entire operating budgets, if we see in this list, if I put this question to you, which one is the most important budget, right? Yes, excellent. You have guessed it. It is the sales budget. It is the sales forecast. Everything stems from the sales budget. And if your sales budget is wrong, if this number is wrong, then your production and material and labor and overhead budget accordingly, that budget would go wrong as well. So this is most crucial and most critical budget to be prepared. So that's why we are looking at that what factors influence the sales budget, right? And there are certain common pointers. Most probably you'll be looking at your historical trend, that how sales have been over a period of time past. And this is all these factors which are listed: conditions, industry conditions, comparator action, pricing policies, credit policies. This we have seen in section B, topic 1. This was the strategic analysis, right? Budget preparation cannot happen in closed doors, that senior managers sit and they say, okay, what should be our sales target, and they just come up with a number and then they try to achieve that target. No, we have to look around. We have how the outside environment is. What are the opportunities in outside environment? What are the threats? There might be new competitors, right? Or there might be an economic recession. So we have to look into broadly political, economical, legal, technological, and social factors when making a sales forecast. Probably this is the most important step, as I have elaborated again and again. Also, another input would be that how much you want to spend on marketing this year, right? So that's another very important input. There's a strong relationship between marketing spend and the sales you achieve. Expected sales and impact on sales from targeted company acquisitions. So maybe your company have done an acquisition or is planning to do an acquisition, is trying to acquire or has already acquired or is going to acquire another business. Imagine that if company have acquired one of its smaller competitors, right? Now the combined company sale is expected to increase, and that must be incorporated in the budget. So these are all the factors, and this can very well be an essay type question topic, that what factors affect the sales forecast, or what factors should be considered. So you might be asked to list 3 or 4 critical factors which impact which must be considered when you're making your sales forecast. So moving on, if you see, this is the first number or calculation that we are looking at. So we have the sales budget, and we have sales, budgeted sales in units, and this is 158,000. So this is just an example. It can be any number, but it is assumed here that it is the result of that very careful consideration, that all after considering all the factor that impact your sales forecast, political factor, economic factors, social factor, legal factors, and looking at historical trend, you have come up with this number. And this A here is just labeling, because we are throwing, we would be throwing so many numbers, right? So this labeling A, B, C is to keep track of that. Now, let's say you have all agreed that budgeted sales for a coming period, that time period is a planning period or budget period. Let's assume it is 1 year. So let's say this is a manufacturing organization, and its manager have agreed that on a sales target of 158,000. So that is simply what we call as budgeted sales in units, or you can say this is budgeted sales volume, right? Please don't mind my handwriting. I wanted to be a doctor early on, so it is in between. So budgeted sales volume. Now multiplied by a selling price per unit. This should be dubbed as budgeted selling price per unit. This is a separate discussion, that how you set this standard or budgeted selling price. Multiply this two. So total sales or total budgeted sales is price into quantity. Your price, budgeted selling price, is 148. Your quantity 158,000. So this is your budgeted sales revenue, and that is $23.384 million. So budget, right? So this is budgeted sales revenue. Now, this earlier in exam, this budgeted sales volume is usually given to you. It's an input in exam question, right? So this is your first budget. This is the top line of your income statement. Let's move on to a more important calculation, right? So the important calculation is the production budget. As a manufacturing organization, you have to make a decision that how much units to produce. My question to you is that we plan to sell 158,000 units. How many units we should plan to produce? What do you say? Should we produce exactly 158,000 units, or should we plan to keep some inventory? Yes, excellent. We should plan to keep some inventory, right? So yes, Ankush, thank you very much. We have to. Now, if I move on to the format of production budget, very, very important. So if you see, it starts from budgeted sales units. It starts from how many units you plan to sell. And we have already, if you see that input is there, it would be given to you in exam that you need to sell 158,000 units, right? So how much do you need to produce? What we do, we add desired ending inventory of finished goods in units. How much you want to keep as finished goods inventory. So let's say this is just an example here, and this number is already provided. So let's say you want to keep 16,000 units in inventory at the end of the year. So 158,000 you want to sell, plus you should have 16,000 units as ending inventory at the end of the year. So total units needed to sell and to keep inventory are 174,000. Now, it might be possible that you already have, because you are selling this finished product, you already have some inventory, right? So less the beginning inventory of finished goods. This would be an actual figure. It would be an end result of an inventory count, that how many units you already have in beginning inventory. So we have to deduct this out of 174,000 needed to sell and to keep inventory. 14,000 is already in inventory. It's called beginning inventory or opening inventory. So we reach to budgeted production in units, or budgeted units to be produced, 160,000, right? So if you see, this gives us the overall formula as well. And if I just summarize that, budgeted production in units, budgeted production is equal to budgeted sales plus ending inventory, desired ending inventory, minus the beginning inventory, right? So that is the formula, and we will have to use this formula again and again. So as I told you, you will be given the budgeted production. You will be given information regarding that how much ending inventory should be and how much beginning inventory should be, right? So it's a simple, straightforward calculation. We can calculate budgeted units to be manufactured. We are talking about finished goods units. Any question at this stage? Right? So yes, Ankush, I'm waiting for your question. So in the meanwhile, so can the production budget be made in dollars? Very good question. Excellent question. So as far as production budget is concerned, it's typically made in units, right? That how many units we want to manufacture. Then this units, it then is translated into cost of goods sold. So that cost of goods sold then is in dollars. So budgeted production or production budget can be multiplied by a cost of goods manufactured or cost to manufacture one unit, and accordingly a dollar amount can be calculated. So yes, it can be calculated, and later on as we move forward, and especially when we see cost of goods sold, there the dollar numbers will come into picture, right? Now what I want to show you here is that in exam question, the exam question is not that straightforward, that you are given budgeted sales and you're giving ending inventory and you're given the beginning inventory and you have to calculate the units produced. So let me give you an exam scenario here. So we are still on the production budgets, right? And we have to calculate in units. So let me give you a typical exam scenario, short but exam scenario, and that will go a long way. So let's say you are preparing monthly budgets, right? So you are given monthly budgeted sales, monthly budgeted sales data is given to you. And let's say for the month of January, any year, the budgeted sales units are 10,000. For the month of February, this you plan to sell 12,000 units. So these are units of finished product. And for the month of March, you plan to sell 15,000 units, right? And April, 20,000 units. So this is data. And after that, what else do you need in order to prepare a monthly production budget? So you would need information regarding the beginning and ending inventory. So you are given one line only, that the desired ending inventory for a month is targeted at 10% of the coming months production, budgeted sales. This is the only information that is given to you. So you are given budgeted sales for January, February, March, and April, and you are told that the desired level of ending inventory is 10% of coming month's sales. And what is the requirement? Required is calculate budgeted number of units to be produced in the months of Jan to March, first 3 months of the year. In the months of Jan to March. So this is a very, very typical exam scenario, and we need to master this. We should be anticipating this question, right? That how do we solve? So once again, look at the budgeted sales Jan, Feb, March, and April, and we have, with reference to inventory, we only have one information, that the desired ending inventory should be 10% of coming month's budgeted sales. So let's see how we solve this. So here is the solution to the problem that I kept in front of you. So here are the months. Let's say month of Jan, and this is a column for the month of Feb, and this is a column for the month of March, right? As we know that budgeted production should be equal to budgeted sales, and this is given. So it was 10,000, 12,000, and for March it was 15,000. Now, plus, what was the formula? Budgeted sales plus desired ending inventory plus the ending inventory. Now, what is the rule regarding ending inventory? The rule is that ending inventory must be 10% of coming month's production. So ending inventory for the month of January would be 10% of coming month's budgeted sales, which would be 10% of this 12,000, right? So coming month for January is February. So 10% of 12,000 is 1,200. Similarly, for February, the ending inventory or ending inventory target for February is 10% of the coming month budgeted sales. Coming month is March, and 10% of 15,000 is 1,500. Right? So now, sorry, I put brackets. Should not have put brackets here. So 1,200 and 1,500. And then for March, 10% of April is, we have seen that April's budgeted sale is given as 20,000. So 10% of 20,000 is 2,000, right? So ending inventory is simply 10% of coming month's sales. Now minus the beginning inventory, right? And that should give us the budgeted production for each month. Now the issue is nothing have been told about the beginning inventory. And this is where we'll have to improvise. And this is the actual problem in this question. Now, one insight. Do you have any insight that what the beginning inventory should be for any month? Right? So I want you to think what should be the beginning inventory for any months. Now, so this is a critical point. The beginning inventory for a given month is ending inventory for the previous month. So let me write here this important insight that the rule is that beginning inventory for a period can be assumed to be the ending inventory of the previous period. So if you had, for example, a finished goods inventory of 10,000 at the end of 31st December 2019, which is ending inventory for year 2019, what is the beginning inventory for year 2020? Exactly the same thing. Ending of last year is beginning of this year. Ending of previous quarter is beginning of this quarter. Similarly, ending inventory for previous month, ending inventory on 31st January is beginning inventory on 1st February. So based on this rule, we can say that the beginning inventory for the month of February in this question would be the ending inventory for the month of January, which is right in front of us, right? So the beginning inventory for February is ending of January, and the beginning inventory for the month of March is ending inventory for the month of February, right? I hope you understand how you're getting this point. This is a very, very important point. So beginning inventory for February is same as ending for January, and beginning inventory for March is same as ending inventory of February. That brings us to once again crucial point. What is the beginning inventory of January? Right? How can we answer the beginning inventory of January? For this, in order to work out beginning inventory of January, let me show you a separate working here. And we will have to go one period back, that before January, it was December. So once we have December and then we have January, right? If we write the budgeted sales again, the budgeted sales for the month of January is 10,000. What is budgeted sale? What was budgeted sale for the month of December? We are not required to know that. So let me write something here, just XXX, just to represent it with a figure. Now, when we were preparing December budget for the month of December, so we needed budgeted sales. We can assume any figure plus the ending inventory for the month of December. What was the ending inventory for the month of December? So as per the information that is given to us, ending inventory for a month is 10% of budgeted sales for the coming month. So what would be coming month in December? January. What is budgeted sales in January? 10%. What would be 10% of that? 1,000. So in December, we would have budgeted an ending inventory of 1,000. Same rule. It is 10% of coming month's sales. So if ending inventory was 1,000 in December, exactly same amount is the beginning inventory. So if I write minus the beginning inventory, so same amount can be written as beginning inventory for the month of January, right? Ending for the month of December, beginning for the month of January. And now I can write here that beginning for January is 1,000. Why? Because it is the ending inventory for the month of December, right? Now, look at it again. We can finalize and we can finally answer this question, right? So now rest is just the calculation. 10,000 plus 1200 minus 1000. So it is 10,200 units. 12,000 plus 1500 minus 1200. Can you give me the calculation? So it is 13,300. Am I right? And 17,000. So this is 16,500. Right? So please check the calculations. So now I believe this is 12,300. Sorry. So this is 12,300. Yeah. Now, once again, look at this question, and you are gonna face many such questions in exam, right? I can tell you. Now, yes, Rajesh, excellent spot. This is 15,500, right? Now, here is an excellent, a trick that we can always use in such questions, right? And what is the trick? And I want you to stay with me on this one. And this is the rule, or this is a trick. If you are told, like in this question, that ending inventory would be 10% of the coming months or coming periods budgeted sales, right? And that period might be a quarter, that period might be a year, that period might be a month. In this example or illustration I gave you, that period was a month, right? But what this automatically means, we can rule for the beginning inventory, that if this is the case, then beginning inventory would be 10% of the same months, 10% of the same month's budgeted sales. Same month's budgeted sales, right? Once again, let me take you to the number. What is the January's ending inventory? It is 10% of February's budgeted sales. It is 1,200, right? But what is January's beginning inventory, right? So we did a long calculation that it would be ending inventory for the month of December, right? And that is 10% of budgeted sales of January. So ending inventory for December would be beginning inventory for January. But there's a shortcut, right? So you can see the beginning inventory for January is 10% of January's sale, and the beginning inventory for February is 10% of February's sale, and beginning inventory for March is 10% of March sale. That's why we can make a rule that whenever you are told that the ending inventory is X% of coming period sale, it automatically means that beginning inventory would be X% of the same month's sale, right? So this, as I told you, will resolve many questions, and this is a very, very important and neat trick that will help you all the way, right? Time to have a short break. Stay tuned. Be right back. Thank you very much.